Hi, very good evening to all. My name is Bhavana and our subject is foreign trade. In this, before we learn monetary measures for control the balance of payments in international trade. Now we are discussing what are the non-monetary measures to control the balance of payments in international trade. Let's see here. Non-monetary measures. In previous we discussed what are the monetary measures. In these measures we have any doubt, please let me know. I definitely clarify your doubts. Now we are shifting to non-monetary measures. What are the non-monetary measures to control the disequilibrium in balance of payments in international trade? Non-monetary measures which restricts imports or promote exports as follows. What is our main aim for disequilibrium? We have to restrict the imports and we have to promote our exports. For non-monetary measures which restricts imports or promote exports as follows. First, tariffs. Tariffs means it is a one type of duty for imports. Tariffs are duties, taxes imposed on imports. Where tariff are imposed, the prices of imports would increase to the extent of tariff. The increased price will reduce the demand for the imported good and at the same time induce domestic procedure to produce more of import substitutes. What this is? Tariff means they are the duties. Duties imposed on imports. Means while we are importing some goods, we have to pay taxes. Who pay taxes? Those who which country they are exporting goods, they have to pay taxes to our country. So tariffs are the duty taxes imposed on imports. Where tariffs are imposed, the prices of import would be increased while the duty of taxes would be increased to the extent of tariff. For example, we are importing 10,000 quantities. Up to 5,000 we are paying some amount of tax. Above 5,000 we are increasing the tax. Then we can import only 5,000. For that reason there is a restrictions of imports. So it is the measure to can say the balance of payments. Here we have to restrict the imports. The imposed prices will reduce. So then imposed prices will reduce the demand for imported good at the same time. So we are paying more tax. Then the demand of the particular product decreases because the price increases, the demand of the particular product decreases. We know that. And at the same time induce domestic procedure to produce more of import substitutes. Which goods we are importing, so that for these goods we have to take substitutes of our home product. For example, we are exporting jute. We are importing jute from other country for 10,000 quintals. But only 5,000 we are importing because of heavy taxes. Other 5,000 quintals we have to use our home substitutes. Then there is a restriction. So from this we can restrict the imports and using our home products. So we increase our revenue and restrict the imports. We can say there is a there is a equilibrium in balance of payment. So this is also one of the measures. I hope you understood. What I am saying is, while importing the goods we have to increase our taxes. For that increase of taxation we have to import some amount of goods. The other amount we have to take in our own products. For that reason there is a we can restrict our imports and also use our home products. Then the balance in payments, the disequilibrium will be equilibrium. Non-essential imports can be drastically reduced by imposing a very high rate of tariff. Non-essential imports means it is not essential for our country but we are importing. Then we have an idea why we are importing. So we can think like that. Then we can restrict our imports based on increasing the tax. Without increasing the tax, we can say that the other manufacturers have import these goods because the taxation is very less. They can sell the goods at cheaper cost. So non-essential goods have drastically imported into our country. For that reason the imports have been increased based on our exports. So it creates imbalance. For this we have to impose high taxation. Then the manufacturers think they do not want to import these type of goods. So we can restrict our imports based on our exports. So tariff is also one of the non-monetary measure for restriction of imports rather than exports. Next, quotas. Quota is also very important. A quota is a government imposed trade restriction. Tariff is imposed by ourselves, but quotas is imposed by the government that limits the number or monetary value of goods that can be imported or exported during a particular period of time. Quota says that we have to receive imports and exports per particular country at some amount at particular time. They have such restrictions of importation or exportation of the goods restricted by the government. So quotas are used in international trade to help regulate the value of trade between countries. Quotas help the international trade while we are trading the goods, means distributing our goods and services through different countries. The quota very help because one country gets more goods and other country gets less goods. So the quota said equal distribution of all other countries. So you can say it is very important tool for exportation or importation of goods and services through international trade. They are sometimes imposed on specific goods to reduce imports, thereby increase domestic production by restriction of foreign competition. Here say they are sometimes imposed on some specific goods to reduce imports. We are imposing some specific goods to reduce imports. We want to reduce our imports, thereby increasing domestic production. We have to improve our domestic production. We have to produce our own self by restriction of foreign competition. Based on foreign competition, based on our importing of goods, we have to self-made of the goods. Then we can restrict our imports. There are different types of quota. Quota is a government restriction. Government said that only the particular good have to be distributed at particular point of time. We are unable to import more than the restrictions. So it is also one of the important for a non-monetary measure to control imbalance of balance in payments account. And there are different types of quotas. The tariff or customs quota, unilateral quota, bilateral quota, mixing quota and import licensing. These are the different types of quotas. Let's see here first. Tariff or customs quota. What is a tariff or customs quota? Tariff or customs quota is a widely used measure under this system. It is widely used, means this measure is followed by each and every country. Import of a commodity up to a specified quantity is allowed to be imported duty free or at a special low rate of duty. But import in excess of this fixed limit are charged high rate of duty. What is tariff or custom quota said? For example, USA is exporting goods, gold to India. We have to import some cages like 50 kgs of gold. 50 kgs of gold only we have very low tax. Above 50, any 1 kg also we have to impose very high rate for all these 51 kgs of goods. So the country has think that we have to import only up to 50 kgs of gold. So there is a restriction. It is a very important term. But import in excess of this fixed limit are charged high rate of duty. So so every country has to import only up to 50 kgs of gold. If extra any 1 unit, up to the whole unit, we have to pay very high rate of tax. For that reason, the country has import up to the rate only. So in this case, we can control our imports. The tariff or outcome quota is widely used a measure under this system. It is widely used, means every country used this measure only. Import of a commodity up to a specified quantity, up to 50 kgs is allowed to be imported. It may be a duty free and at a special rate of tax. In some other cases like necessities, there is no tax up to this limit also. But import in excess of this fixed limit, in excess of these 50 kgs are charged high rate of duty. We have charged very high rate of duty. So we can say it is also one of the measure. Next, unilateral quota. Under this system, a country places an absolute limit. In this system also, country places an absolute limit on the importation for commodity during a given period of time. He says in this particular period, we have to import in this particular like 100 kgs of wheat. So here said only 100 kgs of wheat only we have to import. Unilateral quota. It is imposed without prior negotiation with foreign governments. In this case, we need the prior negotiation with both importer and exporter country. But unilateral quota, there is no negotiation between the foreign country and a home country. It is imposed without prior negotiation with the foreign government. There is no negotiation with the foreign government. Just we have to decide like that, and we have to do. Unilateral quota means only importing country has to take a decision. There is no trade negotiation between the foreign country and the home country. But bilateral quota, under this system, quotas are set through negotiations between, in this case, both negotiation between the foreign country and home country. Why you can say in this unilateral quota means only we are importing the goods, so we can make negotiation only with home country. But bilateral quota means we are exchanging the goods, means exports and imports. So there is a trade negotiation between the both importing country and exporting country. In this system, quota are decided by mutual agreement. It minimizes the superstition of discrimination. They both countries are decided we are export 20 kgs and we are import 10 kgs. So there is a mutual agreement like that. They both countries make a mutual agreement. Then mutual agreement, up to now only the tax rate is very less. For this reason we can import our goods and we can export our goods and we can import the goods. So bilateral quota is a trade negotiation between both foreign country and home country. They make some restrictions up to some limit. That is the reason we can export our goods and we can import goods up to certain restriction only. So you can say this is also one of the measures to control the disequilibrium in balance of payments. What is a mixed quota? Mixed quota means it requires procedure to utilize a certain portion of domestic raw materials along with imported parts to produce finished good domestically. Mixed quota is mainly based upon some quantity. We have to use like we are importing 100 kgs of rice, but we have to utilize only 50 kgs in our production of economy. So the other 50 kgs we are unable to use. So it requires procedure to utilize a certain portion of domestic raw materials along with the imported part to produce finished goods. Up to 50 kgs rice only we can finish any finished bread. We can say it is a raw material. For this raw material we are preparing some bread like biscuits or bread like that. From wheat we are preparing some biscuits or bread like that. Up to 50 kgs only we have to prepare for finished good. So then the importer may import only 50 kgs. The above 50 kgs are not into consideration. We are need not to pay money. So there is a restriction of for imported raw material as converted into finished good. In this case also we can control our imports. Thus, it sets limits on the proportion of foreign-made raw materials to be imported and used in domestic production. Mixed quota is mainly for the raw materials. We are importing raw materials up to some quantity, but the government give permission up to some quantity only. For that quantity of goods only we have to convert it into a fixed good. So there is a restriction of import of raw materials. We can say it is a mixed quota. It is also one of the measures to control the imports rather than exports. And next, import licensing. Under the perspective of imports are required to obtain a license from the proper authorities from importing any quantity within a specified quota. It is also within the specified quota. Importing licensing has become a lending type of quantitative restriction. It is completely quantitative restriction. Under this perspective, importers are required to obtain a license. In this import licensing, while we are importing goods, we have to take a license from the authority, from the proper authorities for importing any quantity within a specified quota. While we are importing the goods with a specified quota, we have to take a license from authorities. For this license only they provide only some quantities of import the goods. They are restricted of imports. So it is also one of the measure for restriction of imports and also it controls the disequilibrium in balance of payments in international trade. These are all the types of the quotas. What are the types? Tariffs or customs quota. Tariffs or customs quota means this tariff or customs quota is it is a widely used measure. Import of a commodity up to a specific quantity. Here only up to the specified quantity is allowed for imports and exports. Then by we can restrict our imports and exports. Unilateral quota. There is no trade negotiation between the foreign countries and home country because we are importing the goods. So we have to decide ourselves. Only the home country we have to decide up to a particular limit only. And bilateral quota. Bilateral quota means there is a negotiation between the foreign country and home country. We are importing some quantity of goods. We are exporting some quantity of goods. There is a restriction of importing and exporting both. So there is also restrictions. And mixed quota. Mixed quota means in this case only some some part of raw materials are used to produce a finished product. For that we can say there is a restriction of importation of raw materials also. We have to import it more than the restricted limit. We are unable to produce or converted into a fixed product. So we can say it is also one of the restriction. And next, import licensing. From some other commodities, when we have to import it, we have to take a license from authorities, so they restrict the imports from some quantity only. For this reason also we can restrict our imports and control balance in payments of international trade. These are all the quotas and types in quotas. Up to now we discuss what is the tariff, non-monetary measure tariff and quotas. Now export promotion. Third step is export promotion. In non-monetary measures, export promotion has been defined as the public policy measures which actually are potentially enhance exporting activity of a company, industries or national level. Export promotion at industry and national level, they have to promote our exports based on the policies principles followed by the government. The government can adopt export promotion measure to correct the disequilibrium in balance of payments. They want to measure the correct disequilibrium in balance of payments. The government adopt the export promotion measure based on our environment. They choose one particular policies and principles. We have to improve our exports and also control the disequilibrium in balance of payments. It is also one of the important measure. Next, import substitution. It is the method employed by the government. To stimulate the economy by substituting domestic product for similar imported products. Import substitution mainly says that while we are importing any goods, we have to think about the substitute which are produced in our country. So for that we are unable to import the goods. We use our own products. Then we can restrict our imports. A company may resort the import substitution to reduce the volume of imports and make it self-reliant. The government also thinking because of importing the goods we have to self-produce in our own country. For that we can restrict our imports. If we produce the goods at cheaper cost, we can export these goods to foreign countries. Then we can increase our exports. There is a restriction on imports. So we can say this is also control in a balance of payments of international trade. Import substitution means the government want to think which goods we are importing. For that importing goods we have to think about the substitution of our goods which are produced in our home country. For that we can restrict our imports. These are all the non-monetary measures for controlling the balance of payments in international trade. What are the non-monetary measures? Tariffs and quotas. Quotas are subdivided into a tariffs and customs quota, unilateral quota, bilateral quota, mixed quota, and import licensing. And third, export promotion, and fourth, import promotion. These are the non-monetary measures for control of balance of payment in international trade. I hope you understand the lecture. If you have any doubt regarding this today's lecture, please let me know. I definitely clarify your doubts. Guys, up to now we complete 2 units. Let's see here. Unit 1 already I said. Unit 1 foreign trade, meaning and definition, types, documentation. I clearly explained which documents are used for importing and exporting of goods. And next unit, introduction, meaning, what are the components of balance of trade and balance of payments, concept of disequilibrium, causes, and today we are discussing remedies for correcting the balance of payments in international trade. Up to now we complete 2 units. If you have any doubt regarding any particular concept, please let me know. Up to 2 units, follow the videos and watch everyone, because there is an interlink between 1 and 2. If you miss one video, the other lecture may not be understand. So follow all videos, then you can get a better understand. I hope you understand this lecture. If you have any doubt regarding this up to 2 units, please let me know. I definitely clarify your doubts. In the next, we are starting our 3rd chapter, that is Indian trade policy, importance and its implementation, current export and import policy. If you anyone want this syllabus copy, let me know. I definitely share with this group. Thank you so much.